Good day, fellow investors. The S&P 500 is close to all-time highs, especially this year. So the key question now is, what will crash it, whether the crash will be in 2026, but perhaps more importantly, if we invert that, what can push it higher? And if you look into that question, the Fed is going to cut rates. We just discussed Larry Fink and Brian Adams discussing how the government might juice the market with lower rates to push it higher in 2026. There is still the hope of earnings growth on AI that will lead to more flows into the market and push it higher. If you look at the market capitalization of the S&P 500, it is $58 trillion. And then going to the research from Harvard and Chicago, Gabaix and Cohen, that discuss the inelastic market hypothesis, where you can read this on SSRN, we find that every $1 invested increases the market value by $5 to $8. More about that also in my video discussing the great research they have found explaining the current markets. So if $1 in pushes the market up, we have to look at flows at the first and most important factor when it comes to the stock market. The S&P 500 is up 17% over the year, and if we look at the situation there, 17% for the year, that means that the market capitalization was around 50 trillion at the beginning of the year. What has happened? If we look at the last 12 months of buybacks, great chart from Yardeni, those are around $1 trillion for the year. $1 trillion in for buybacks, 5 trillions up. Then if we look at the ETF inflows, 1 trillion mark, fastest run on record, going to hit 1.25 trillion inflows, US ETFs over the year for a record high. Let's say 1 trillion net inflows in ETFs, that's another 5 trillion. That's the market already up 10 trillion. We just discussed Larry Fink and Brian Adams. They are doing everything to get more fees off of you, and for that they will need more flows. And those flows might come up with Fed cutting rates big time, more stimulus midterms coming in. Brian Adams said juicing the market. Let's say that positivity, AI, spending, this and that, that's another 5 trillion up. That means that this market now at 58 will be around 70 something trillion in the next 12 months. Therefore, it will be up 20%, all else equal. No crashes, no nothing. The stock market will just go up to the moon forever. In numbers, that would mean at 8,300 market by the end of the year. Just if you look at flows and everything remains as is. But now that we know what can push it higher, which I think is the most likely situation, we never know when can a market crash. It's impossible to predict. But let's look at what can crash it. Just a note here on fundamentals. Why are we just discussing flows? So last weekend we discussed how the shareholder yield is at best 1.9%, and that will not make you retire or whatever. So this market is a gambling market, speculative market, just on flows because the fundamental yield is at crazy historical lows. So the question is, what can reverse this? Well, we first would need a recession, because when there is a recession, buybacks get to a halt, and therefore with stock-based compensation those are negative. So that would take out 5 trillion of the upside. Also, if these inflows revert and become net outflows, that might take again 5 trillion there. However, we discussed this is all about flows, and Larry Fink mentioned how most people globally have now an allocation to the US, how they are overweight their US situation. There has been a slow reduction, but they are still overweight. If we look at the market capitalization of the US is 65% on a global basis. If the rest of the world decides, okay, let's go to the rest of the world, that would mean a significant outflow. However, they will keep on investing as long as stocks go up. So a reversal there, panic, a significant drawdown without more inflows. So when people would say, okay, this yield is ridiculous, there is no point investing more in the S&P 500 because it will not go up. It's just a psychological shift. When that happens, that is the time the market will crash. Then we also have the job market. If we look at the job market, has been stagnating, not growing that fast anymore. So if there is a drop there, that might also have an impact on flows, more people retiring. This number over 65 is growing. It was 12% of the population, now it's 18% of the population, and now they should start selling their assets because they should use that money for retirement. So that is also a possibility there. I might say it as a joke because that's how it will be interpreted, but if the Fed is unable to cut rates, or it cuts rates but it doesn't work, so when the modern monetary policy idea will come to an end because the more you use those tools, the less effective they are, that might be something. Higher rates, permanently higher rates, inflation, but that would need a different world, that would need Fed rate cuts not working, foreign flows reversing, yield going up to higher interest rates, recession, AI bubble bursting, buybacks out, pushing the can down the road does not work anymore. That would be something that might revert the S&P 500, which would be a completely different world to the one we are having and enjoying now. Michael Burry predicts it will happen, at least for the AI bubble, in the next 24 months. I'm not going into predictions, I'm just looking at the fundamentals, how those don't make sense, how maybe politics might change. Warren Buffett already sold his Apple because he said in the future taxes will be higher. That is because 10% of people own 90% of assets. When the poor get fed of this situation, they might go after the rich, that's higher taxes, and it's all about elections. You can print the money, but that leads to inflation. In the US, 25% over the last 5 years, so crazy higher prices. It will look ugly, everything will fall down. When? I don't know. And then you say, Sven, you have been saying that since 2018, and that is correct. Since then, the S&P 500 has been overvalued for me, risky. The market did 15% since then per year, so did I. And that is what I'm telling you. Focus on the fundamentals, get a return from fundamentals, not from the market, because on one side you are betting, on the other side, whatever happens, you should do well. That's my message, not predicting. Find a way that whatever happens, you do well. And perhaps you need to think in a decade, 5, 10 years down the road. Maybe the next crash will be 2032. Who knows? But it's about the long-term compounding of your wealth with the highest degree of certainty. That's my message.